Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Today is September 25th, 2014, and this is episode number 4 of Accredited Investor Markets Radio. Welcome. Our guest today will be Jason Stevens, an expert on investment portfolios focused on natural resources. But first, some news and other information. If you have been listening to us regularly, or if you read AIMKTS.com, or if you do both, which would be wonderful, you know by now that we are not here to sell you on alternative assets. Quite to the contrary. Our mission here at Accredited Investor Markets Radio and the broader mission of AIMKTS.com is to educate you so that you can decide whether to invest in alternative assets at all. Then, and only then, if you decide the answer is yes, do we consider it our mission to help you decide how to do so. To wit, I encourage you to check out the article published to AIMKTS.com on August 15th. Its title is To Be an Angel, an op-ed piece by Stephen Bornstein. As he writes near the beginning of his piece, betting on startups is a very risky business, and the chance that the startup you choose to invest in will fail is very high. I encourage you to read the article in full. Please go to www.aimkts.com and look at the News tab and search by date. Something else I've been meaning to commend to you is a book called The Investor's Guide to Alternative Assets by Jonathan Friedland. I must make it clear that I may be somewhat biased. The book was published by the same company that owns the producer of this radio show. Mr. Friedland is the founder of that company, and I'm honored to say Mr. Friedland is a good friend of mine. However, in my view, it is the single best book you can possibly read about alternative assets. I would go so far as to say that you would be irresponsible if you did not read it before making an investment into your first alternative assets. The book is available at the Kindle store, the Apple iBook store, and at barnesandnoble.com. Please go to any of those sites and search for the words Friedland and investor, and it will pop right up. Now, Friedland is spelled Friedland. What else do I have for you this week? This one's a little dated. It's from August 5th, 2014. Anthony Effinger wrote for Bloomberg.com an article entitled Family Offices Chasing Wealthy's $46 Trillion in Assets. It is an interesting look at the firms that compete to manage the money of the wealthiest of the wealthy. And who are the top firms? HSBC is number 1. 340 families, $137.3 billion in assets. Northern Trust is number 2, 3,457 families and $112 billion. I'll stop there for a moment. That's 10 times as many families and slightly less in the total amount being managed. In other words, HSBC is number 1 by a long ways. Bessemer Trust is number 3 with 2,200 families and $77.9 billion. One more recommended reading. Business Insider published a great piece on August 23rd by Mamta Badkar that anyone currently invested in bonds should read. The title of the piece is The Riskiest Thing Bond Investors Are Doing Right Now. We have with us today Jason Stevens, an investment executive at Sprott Global Resource Investment Limited, which is a preeminent resource-focused investment firm. Sprott Global is a U.S. broker-dealer focused on the natural resource sectors, including precious metals, base metals, oil and gas, agriculture, water, and alternative energy. Sprott Global employs geologists, mining and petroleum engineers, and specialists in the resource finance sector in order to provide its clients information to make informed natural resource investing decisions. Sprott offers full-service investment brokerage, including both secondary market and, for qualified investors, and that's you listeners, private placement products. So the first thing, Jason, I'd like to note is that you've been at this a while, haven't you, with Sprott?
I sure have. It's been 12 exciting years here at Sprott Global.
Great. I mean, it's a very focused company, and you've been obviously part of that focus all that time.
Yeah, what we've noticed is that there's a lot of financial firms that want to be the jack of all trades and master of none. And what we've noticed is that focusing all our time, effort on natural resources, we have a very prominent market competitive edge. So we focus on one thing, resources, and we're very good at it. We employ about 160 different professionals in terms of geologists, engineers, other sort of resource specialists that help us in our due diligence process, and we're investors ourselves. So eating our own cooking and participating alongside our clients is very important to us.
Well, all right, and I guess maybe as we speak going forward, we'll bear in mind that to the non-specialists, natural resources sounds like oil and gas and strategic minerals and gold and so on. But you can certainly go beyond that and still be in natural resources, as you will perhaps note from time to time. So, Jason, what sorts of risks should be taken into account by an investor when evaluating a natural resource investment opportunity?
So broadly speaking, what I'm usually referring to when I talk about risks is usually risks in the metals and the energy sectors. And I really categorize them into 4 different categories, which is geopolitical, financial, technical, and managerial. So the first being geopolitical, and as most people can understand, that resource land or resource projects are fixed targets for politicians. And obviously, you do business in one area because you have to do business there. Any rational businessman, when they're not treated well in a certain jurisdiction, would pick up their company and leave that jurisdiction. In terms of resource projects, you can't do that. So social licenses, permits, taxes, government royalties that they impose, all of these things are risks to a mining or energy company. The next is financial. A lot of these, a hole in the ground, which we may call a mine, and is not open to the same sort of financings as maybe most businesses, which are very much more understandable by the banking industry. So usually we say that we make money in the investing business or in the financing of these resource companies by answering unanswered questions. And so making sure that your investments, those companies, have enough money to bridge the gap to answer those unanswered questions, as opposed to, in a lot of bear markets, a lot of these resource companies raise financing, dilute shareholders, go out and take loans just to pay salaries and keep lights on. So making sure that you have the financial ability to answer the unanswered questions. Technical. So technical risks are risks like geology, metallurgy, which is basically the ability to recover economic minerals, infrastructure, making sure that there's water, roads, facilities that can make the whole process of mining or energy production economic. And the last is managerial. Do the people that you're investing in have the capability of answering those unanswered questions, meaning do they have the background, do they have the financial market background, do they have the geologist, engineers to do what they're being paid to do, whether that be, obviously you don't want somebody who has all their experience in porphyry copper deposits in South America when they're looking for high-grade uranium deposits in the Athabasca Basin. That happens a lot in the junior resource space. That's something that we're not interested in financing. Also, you want to make sure management is well incentivized, meaning they own shares themselves. And be careful here because we're not talking about management owning stock options. Stock options don't incentivize companies to not lose money because they have no pain if stock prices go down. When stock prices go up, they benefit, but they don't feel any pain when the stocks go down. So that's another risk that we see in terms of management, making sure that to have the right people in place.
Well, I find this four-way typology very powerful, and not just in the natural resource sector. And I guess moving backwards, we could see that each of the managerial, technical, financial, and geopolitical risks are present to some degree in many kinds of investments. I suppose every investment you should look at managerial risk because it's a matter of managerial competence and excellence to take into account. Although, as you were indicating, natural resources present special problems in that regard. And you might even say the same about technical risks. Any manufacturing enterprise will have technical risks. Anything with IP will, but natural resource investing presents a special kind. And then you've indicated special financial risks because of perhaps the scope of these projects require a great deal of capital. Would you say that?
Yeah, so these sorts of businesses are very capital intensive, and the collateral that most traditional financing would assume is just not available. Getting a banker with an MBA to understand the net asset value of future cash flows of a copper mine is impossible. So that method of financing is unavailable, and so a lot of times permanent financing is very difficult, and you have to go to infrastructure banks, you have to go to equity or more speculative equity issuances, you have to go to higher rate bridge loans and mezzanine loans for refinancing.
I was going to say, it sounds like the interest rates would be a lot higher for financing, right. So that, and then that drives the effort to seek investors, speculators, and others. And
it depends on what stage in the game you're at, but certainly if you haven't identified or haven't created what they call the National Instrument 43101 in terms of the mineral resource and reserve reports, if you don't have that yet, obviously your options are limited as well. And infrastructure loans are always available for those investments or for those mines or energy projects which have those reserve reports.
Okay, and I just wanted to, before we get to the stages, just comment on geopolitical risks. That is a risk which is not peculiar to natural resources, but I think must be particularly pronounced for natural resources because, after all, you're extracting from the ground in a particular place at a particular time. So the political and regulatory environment and stability in some cases must be a key concern.
Absolutely. And in terms of political risk and the legal setting for those political jurisdictions, the whole way through, these companies need to have a plan to either address risks that the market sees or continue to be very transparent with the bureaucracy that they're dealing with.
Yes. Well, okay. All right. So that's typology of risk. Now let's talk about the progression of stages through a natural resource project. They're not all the same. What stage you're investing might make a great deal of difference. So how do the different stages of a natural resource project present different risks and opportunities?
So there's three main stages that I identify with, and one is exploration, one is development, and one is actually production or mineral production. Exploration, obviously, it's highest risk, highest potential reward. You are basically answering the question, do they have anything of economic value? And the risk is obviously that they don't, and the potential reward is that they identify something that goes from raw land, which we jokingly call a liability on the balance sheet. Land is not something that you want to be stuck with if it has no economic value. But if they find something, obviously, something that can be shown to shareholders and potentially lenders that they get more money to develop and create future cash flow. Development obviously the biggest risk here is that you've identified something, but it requires hundreds of millions or billions of dollars to develop. That is huge concern, along with the politics, simply because sometimes the politics becomes the biggest risk for financing and increasing the interest rates that infrastructure costs. And also shareholders need to pony up some money along with the debt holders. So if those markets are broken, whether it be debt or equity in a bear market, it becomes very hard to finance those very capital-intensive businesses. And then finally, the actual exploitation of mineral or oil and gas, execution risk is obviously a huge concern. Do you have the management in place that have they accounted for all the contingencies? Is the metallurgy working? Metallurgy meaning, are they able to recover the amounts of whatever mineral or oil and gas that they had assumed in their modeling? And then also, and lastly, which is very hard to predict, your price risk. Are you getting $100 per barrel for your crude, or are you getting a slight discount because it has some sort of other sort of substance, sulfide or something in the oil that makes it go through another refining process? So pricing, whether it be for your product or derivative of your product, is very important at that point. So for mining, this is especially hard because sometimes when you actually discover a mine, it takes 8 to 10 years before it actually goes into production. So trying to forecast what prices will be for gold in 10 years is nearly impossible.
Jason, your comments, especially your comments about recovery, made me think about fracking. And just historically speaking, if you can, at some point before fracking became the big deal it became, the technology existed and people were pricing the use of fracking to recover oil. And obviously that affects the exploration stage, because if something can be gotten out of the ground not through conventional means but only through fracking, well, that makes a giant difference as to whether the exploration is valuable or not. Do you believe that, or was it the case that the market accounted appropriately for fracking, or was it a surprise how valuable it became?
Well, I think we're still going through that price discovery process, because there are so many areas that haven't necessarily pulled back on a lot of their fracturing. In fact, and I think for the better, they've come up with multi-stage fracking, where they don't just frack once, they create a horizontal leg to their oil well, and they do multi-stage fracking in several places. And building into the models the ability to recover those sorts of, that same amount of oil may take, triple to 4 times the amount of time, which obviously in an economic model means that you get paid back in a much longer time frame, and the economics to an investor are just not there. The NPV and the internal rates of return on that investment are very much less attractive.
Okay.
So I don't know if that answered your question, but in terms of did we account for that, the pullback on hydraulic fracturing, I don't think there's any way to completely model what happens if we start pulling back on that technology, because it is, quite frankly, what is it, at least 50 years old.
Okay, but we're in a very dynamic situation about its employment and its development and its refinement, so to speak.
Absolutely, and that fracturing that's taking place here in California is definitely under scrutiny. What's happening in offshore California is definitely under scrutiny, and I don't think that the people against it or opposing it understand the critical mass that would have, not only in developing future developments here, but what current production would look like without fracturing altogether.
So geopolitical risks aren't present simply in tin pot dictatorships, but they're present in just local environmental concerns in the U.S.
Absolutely.
Now I'm going to shift gears here away from oil and gas by presenting an amusing little scene. Many will recall the scene early in The Graduate, in which the beamish Benjamin Braddock, fresh out of college, is given a solitary word of advice from one of his father's friends, and that word of advice is memorably plastics. So, Jason, might it be not out of place at a pool party in 2014 for a similar scenario to take place, but instead of the word plastics being breathed meaningfully into the young man's ear, the word would be water? What do you think of that?
I think that would be very time appropriate for what we're going through here in California. And what we're looking at right now is the highly politicized municipal markets losing the battle in terms of scarcity. And it's not just here in California, because these sorts of droughts happen all over the place, but because of things like oil and gas production and the Central Valley farmers, droughts just kind of exacerbate the problems, the water supply issues to some of these most critical industries. And I think making these water investments now is just exploiting what I believe will be the inevitable transition to the less subsidized, higher priced water markets. And now the job of the investor is to find out what investments take advantage of those price spikes in the water rights market. And we've identified a few, but I think for the most part, what water rights investments currently exist are very few and far between and not available to the independent or the retail investor.
So it sounds like what you're saying, and correct me if I'm wrong, if I encapsulated or recapitulated incorrectly. Right now, it's not Chinatown, which of course was a dystopian view of political control over water rights, made about the same time as The Graduate. So it's maybe not quite Chinatown, but it is highly politicized quasi-market. And it's your belief that under the conditions of scarcity, which are becoming worse, in California and perhaps other places, markets will have to become more market-like, and that presents investment opportunity. Is that correct?
Yeah, so I guess let me start from the beginning, and I apologize if I kind of went off on my own tangent, but a lot of the agricultural land here in California, and this also goes for other places in the U.S., but I'm most familiar with this here in California. A lot of the farmers never had to compete or pay market prices for their own water. Whatever they picked up off their own land and whatever flowed into their land was theirs and would never have competitive pressures from urban interests. So you wouldn't see the LA municipal county interests looking to buy that same water. That's starting, basically all the subsidies going into the agricultural farming has stopped, and certain farmers have obviously voiced their opinions against that. Well, what happens is some of this water cannot be exploited by the farmers, and they'd rather go ahead and sell it to urban interests now. Well, now they have to be retitled in order to be sold as urban interests. And that's starting to happen by certain farmers because they can get higher prices in the urban markets rather than the agricultural markets. So that's starting to happen, and it's going to happen on a wider scale now that we have the issues that we do here in California, and it's starting to leak through to industries like oil and gas, where hydraulic fracturing is very water intensive, where obviously agriculture, biofuels, a lot of our most critical industries, mining is a huge consumer of water, of fresh water. So it will certainly be an interesting development when it comes to how water will be allocated outside and away from bureaucrats and municipalities.
Let's turn to another resource, which is uranium. Of course, the use of uranium in energy has been a matter of great scrutiny over the last several years, well, maybe over our respective lifetimes. Is it a good opportunity for investors?
I think uranium and nuclear energy is probably one of the most exciting stories in the energy investments right now. simply for the fact that we're in a unique place where nuclear reactors are going up, I think over 50 in China. We're having nuclear restarts in Japan. So obviously Japan is a place that, in all in all views of the public, just had a true disaster. But they're going right back to it because obviously it's either the lights go off or they go back to nuclear. China doesn't have the political pressures that the Western countries do, and all they really care about is cleaning up their air and getting power to their constituents. So even though we're bringing down our nuclear capacity here and not issuing new permits for nuclear reactors, the nuclear capacity over the world is actually growing bigger. At the same time, the long-term rates and the uranium spot markets are too low, meaning that most of the uranium producers right now are actually taking losses on every pound of uranium they produce. So nobody, and there's been a series of companies like Cameco and Areva that have done studies on obviously their marginal cost of production, and it ranges from $40 per pound to $70 a pound. So you have demand, which in the future, and actually within the next 2 years, we could see a deficit in supply to the uranium market, and you're not having a price that incentivizes new production or new mine finance.
Sounds like there should be some opportunities there, but I didn't want to leave the topic without mentioning Eastern Europe and Europe in general. Obviously, there's a political problem between Europe and Russia, especially Eastern Europe and Russia. Do you see, or have you become aware of increased desire in that space? When I say space, I mean geographical space, for enhanced use of nuclear energy to compensate for the increasingly unreliable sources of energy from Russia?
I can only speak to rumors that I've heard that obviously there's been more talks out of places like France and Germany to provide nuclear, obviously utility from uranium or nuclear facilities to places like the Ukraine, but I don't have anything really material to support that.
Well, all right. We here at Accredited Investor Markets Radio, we interview all sorts of people, and we'll be doing some shows, or we've done some shows with people who have platforms that enable the exchange of information between accredited investors and potential investment opportunities. The platforms bring together investor and opportunity in various ways, various interesting ways. But Sprott Global is not a platform. Are you going to create a platform, and what is it you do, if not a platform, to bring investors and opportunity together, in particular accredited investors?
So alongside being a full-service broker-dealer focused on natural resources, for accredited investors and qualified investors, we provide private placement opportunities to our clients that are looking to take advantage of where we are in the natural resource markets or natural resource investments. And we've been very successful with the idea that not only do we want to invest in these businesses, but by providing capital in resource-intensive businesses and monetary intensive businesses, we want to also negotiate for things like a discount to market or warrants, which is the right but not the obligation to exercise at a certain price for a set number of months. So obviously leveraging the upside of investment without creating additional downside. So private placement opportunities are something we offer our accredited clients. And then we also do partnerships, limited partnership structures for accredited and qualified investors that are focused on doing a portfolio of these private placements, again, giving not only a overall view of our investment process, that are these deals that are vetted by our geologists, engineers, but also a long-term approach which we take advantage of the market volatility that's inherent in these cyclical and volatile resource markets.
So they can spread the risk around of their various investments and speculations.
Right. So our founder, Rick Rule, who's been in the resource business and has financed billions of dollars worth of both debt and equity loans, or debt and equity investments, private placements. He is the general partner, invests alongside, usually invests 10% alongside his partners. And then he gets guidance from our geologists, engineers, and this long 10-year lockup period that we look over that time period to take advantage of the wild swings that we see in price and cyclicality of these resource markets. So one thing we say is either in resource markets, you're either a contrarian or a victim. And if you don't take advantage of the bear markets, you will be a victim to the crowd, which a lot of our mutual fund competitors have in terms of disintermediation. So they're forced to sell when markets are low and buy when markets are high, when the money starts flowing back in.
Yeah, don't do that. Don't be a victim.
Right.
It's a very interesting approach, Jason Stevens, and I thank you for presenting it on this program.
Great. Thank you very much for having me.
That was Jason Stevens of Sprott Global Resource Investments Limited. We were very glad to have him. And on behalf of Accredited Investor Markets Radio, this is Christopher Cahill, thanking you for listening to Accredited Investor Markets Radio. Let's do this again sometime soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.aimkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.aimkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.